through a couple of more details and a couple of more reactions on that. We have Jahangir Aziz of JPMorgan, who's joining in on the line from Singapore to discuss the impact. Jahangir, hi. Thank you very much for joining in. You've had some time to mull over the positive outlook which Moody's has given India. Your thoughts?
Look, again, I mean, like other analysts, I think it's a great move. It's very, very positive for India. The fact that they were the first of the three rating agencies that have moved from stable to positive means that it is likely that other rating agencies could also start improving their outlook. So clearly, this is a good day, and it shows the impact of all the efforts that was done since the 2013 near crisis that we had. So both in terms of improving macroeconomic stability as well as growth prospects.
Jahangir, hi, morning. So, what kind of move do you expect in Indian, debt market, equity market? Do you expect a lot of inflows into India because of this outlook upgrade that we have seen?
I don't think so. I mean, I don't think that either equity investors or fixed income investors these days matter more than equity investors, given the sizes of their inflows. I don't think their decisions will change. I think it will give them more comfort of going long India, but I don't think that per se changes very much. It doesn't really trigger a new round of automatic increases in allocations.
Okay. Jahangir, personally, how comfortable are you on most of the macro parameters that we are currently working with? For example, the fiscal deficit, secondly, maybe the CPI as well, with the risk of it possibly inching up in the month of March itself?
So on the inflation dynamics, I think obviously the weather will play the spoiler. I mean, what impact it will have, or going forward, what might have, it's something that is literally up to the gods. So can't do very much about that. But if you leave that aside, I think the trajectory, our inflation trajectory, is very much like that of the RBI. That it is going to bottom out sometime in the second half, in the end of the first half of this year, and that starts inching up. And when it starts inching up, it most likely will be driven by the fact that oil prices will pick up in the second half of the year, not dramatically, but it will firm up. In addition to that, if we are all looking for higher growth to take place, that necessarily has to be accompanied by some firming up of core inflation. In fact, we've already seen core inflation firming up at least for the last 4 or 5 months. So that trajectory, we have a very similar trajectory, and therefore, obviously, by implication, our rate cut call is one of the lowest among analysts. On the fiscal policy, I think we have a slightly different view from the rest of the analysis that has been done in the market. Our own sense of looking at both the central government budget as well as at least 9-10 of the large state budgets that we have already seen is that this will be for the first time since 2009 that the budget has moved out of a consolidation mode into an expansionary mode.
Okay. Jahangir, so what's the biggest risk to Indian macro at this point in time? Is it an assumption that crude prices will remain where they are, and if in the second half we see a bit of a surge, could that derail the story that we have seen for last 6 months or so?
I think that's less of a risk now than it was probably in 2013 and 14, largely on a couple of accounts. A is that we are seeing a cyclical upturn taking place. So no one is saying that the economy is completely out of the woods, but at least the decline has slowed down. Even a year back, it was even difficult to say whether the economy had more space to slow down or where the end we were seeing a bottom. I think most high-frequency data would suggest that we have basically bottomed out. The question is, how fast will the growth pick up? Clearly, the low oil prices has been a big boost. Having said that, the oil price impact has largely been felt on the current account. So if you look at the buffers that Governor Rajan has been talking about, that's been the biggest impact. If you look at the impact on consumption and investment, there the impact has been very, very small so far. So there has been a significant increase in household income taking place because of the low oil prices. There has been a significant improvement in margins, clearly because of the low oil prices, but we have neither seen households consumption pick up, neither have we seen corporate investment picking up. Both households and corporates seem to be saving most of the windfall gain, and this is also the case almost across the world at this point in time. So clearly it's a current account, and to some extent the current account will weaken if oil prices go up, but we have used up that windfall and the capital flows to build up significant amount of reserves. So I'm not that worried about a pickup in oil prices derailing the growth story.
And what is your GDP estimate for this fiscal?
I think we have about 7.8, 7.9. I think, look, all of us are going by the same rule of thumb. Whatever is this year's estimate from last year, just add half a percentage point more. That's what the government is doing. That's what RBI is doing. I think all of us are doing exactly the same thing because we really do not have a sense of where, CSO's estimates and to what extent that's consistent with the high-frequency data that we're seeing.
Okay. Jahangir, I had one last question. We haven't seen the bond markets move too much on the back of the Moody's outlook, upgrade in terms of the outlook itself, which has come in today. It's just about moved around 2 to 3 basis points versus yesterday's closing, and post the hardening that we saw post the RBI policy. What is it mostly reacting to at this point in time? The fact that maybe the RBI is not going to cut as much as it was anticipated earlier?
So there are two sort of big drivers of the bond market as I see it. I mean, one is a very fundamental driver of the bond market, which is that there is no bank credit growth. So even if deposit growth is slowed down to 50-year lows, it is still large enough to ensure that banks continue to buy and keep investing in the bond market way above its SLR requirements. So as long as bank credit does not pick up, the pressures on the 10-year rate is going to be minimal. So that's the first thing. I would say the second thing is that, the expectations of rate cuts. And, the market obviously had a significantly more rate cuts, especially at the 5-year OIS level, not so much at the lower end, but at least on the far end of the curve, there was a significant amount of rate cuts that were being priced in. And I think obviously the RBI statement created some degree of dissonance in that view, and you're seeing some pickup taking place. But I would say that the fundamental driver of 10-year rate is simply that nominal GDP, real GDP isn't picking up, investment isn't picking up, credit growth isn't picking up.